In this video, we're going to discuss loss contingencies surrounding environmental liabilities. An example of an environmental liability would be the cost that Exelon is going to have to incur to dismantle the cooling towers at 3 Mile Island. So our question becomes, when and how should a company recognize this potential loss contingency? A company must recognize an asset retirement obligation when it has an existing legal obligation associated with the retirement of a long-lived asset and when it can be reasonably estimate the amount of that liability. So again, Exelon has an obligation to dismantle 3 Mile Island, so it needs to record an asset retirement obligation on its books at the time those cooling towers in the plant was put into operations. Let's take a look at this from a conceptual perspective. Typically, if a company was depreciating plant and equipment on a straight line basis, it would take the cost of that asset minus any estimated salvage value and spread it over the asset's estimated useful life. And again, the difference between the cost and that estimated salvage value is referred to as the asset's depreciable basis. And we want to match that cost with future revenues. And we do that through something like straight line depreciation. What if instead of being able to sell the asset at the end and receive a cash inflow, which is our estimated salvage value, and is deducted from the asset's cost to calculate the depreciable base, what if we were going to have to spend additional dollars when we retire that asset? Again, think 3 Mile Island and all the costs associated with dismantling that nuclear plant. Well, in that case, we want to take the asset's initial cost and add to it the estimated asset retirement obligation, and we're going to want to spread that cost, which is a depreciable basis, over the asset's estimated useful life. Let's take a look at a journal entry to record a basic asset retirement obligation. If a company has an asset retirement obligation with a $50,000 present value, what we're going to want to do is we're going to want to increase the amount of the plant asset by $50,000 because we're wanting to increase its depreciable base, and at the same time we're going to record a $50,000 asset retirement obligation or liability on our books. So over time, as we depreciate the plant asset, that $50,000 will be spread out over the asset's useful life through the process of depreciation. And our asset retirement obligation, we're going to need to accrue interest on that since we recorded it at its present value. So that's less than the amount we're going to pay in the future. And we've calculated that present value using some sort of discount rate. And so over time, we're going to record interest expense. And we're going to increase that asset retirement obligation. Before we look at a specific example, let's just consider some events that might give rise to environmental liabilities. There's the one I mentioned earlier about Exelon, which would be decommissioning nuclear facilities. We also might be dismantling and restoring and reclaiming land from oil and gas exploration properties. We might have certain costs associated with closure and reclamation and removal costs of mining facilities. Think about when we've done strip mining and we have to restore the land to somewhat to its original condition. Or perhaps the closure and post-closure costs associated with landfills. So in all of these cases, we are going to want to record the present value of these estimated future obligations as part of the asset's cost and a related asset retirement obligation. Again, there's our basic journal entry. Increase the asset cost and record an asset retirement obligation. Let's look at our example now. We're told that Metlock Company purchased an oil tanker or oil tanker depot on January 1, 2020 at a cost of $629,600. And we expect to operate the depot for 10 years, at which time we will be legally required to dismantle the depot and remove the underground storage tanks. It's estimated that the cost will cost $76,420 to dismantle the depot and remove the tanks at the end of the depot's useful life. We need to prepare the journal entry to record the plant asset and asset retirement obligation, and we're going to assume a 6% effective interest rate when we calculate the present value of that asset retirement obligation, which we find is $42,672. So our asset, or our journal entry to record the purchase of the depot, we debit planned asset for $629,600 and we credit cash. Then we need to record a asset retirement obligation, and that's going to be the present value of that $76,000 discounted at 6% interest for 10 years. And of course, we debit the plant asset. We don't record that as a separate asset because it's nothing that we can sell or dispose of separately. It is part of the original plant asset. Let's go ahead and prepare the journal entries required for the depot and the asset retirement obligation at the end of the year, December 31st, 2020. We're told that METLOC uses straight line depreciation and the estimated salvage value for the depot is 0. And we're going to record, in this case, the depreciation on the depot and the asset retirement obligation as separate journal entries. But in practice, we typically don't record the ARO as a separate asset account because it has no future economic benefit apart from that of the asset itself. So let's go ahead and take a look at our journal entry for depreciation expense for the first year. We were told that the depot, which costs $629,600 and has no salvage value, we have an estimated useful life of 10 years. So cost minus salvage divided by 10, depreciation expense will be $62,960, and of course we credit accumulated depreciation for the same amount. The depreciation expense on the asset retirement obligation will be $4,267. This is the present value of that estimated ARO, which we recorded as $42,673. Minus salvage over its spread or its useful life of 10 years, we've got that depreciation expense, and of course we will credit accumulated depreciation. We recorded that asset retirement obligation at its present value of $42,673 rather than its estimated future value of $76,420. So what we need to do is we need to record interest expense and an increase in that estimated liability on an annual basis for the next 10 years. We were going to be using our effective interest method, and we had an estimated interest rate of 6%. Here's our amortization table, our times 0 liability, and years 1 through 10. We aren't going to contribute anything directly to this, and so our payment field is 0, and we simply need to calculate our interest and the balance that it will build to. The annual interest expense is simply the expected return that on any assets that we have invested to settle the ARO. So it would basically be that prior balance times our interest rate, and we've got an Excel formula. The new asset liability would be the prior balance of $42,673 plus the accrued interest of $25.60. And we can copy that formula all the way down our table. And we see after 10 years, the future value of that asset retirement obligation after 10 years will be $76,420, which is what we expect to have to pay to settle that obligation. So our journal entry each year will be to record interest expense and an increase in the asset retirement obligation. Those entries will come directly from our amortization table. Next, we're told that on December 31st, 2029, METLOC pays a demolition firm to dismantle the depot and remain the tanks at a price of $83,620, which is a bit more than we had anticipated. So we've got a loss on our retirement, which really is our plug that we would want to calculate last. We've got to take our asset retirement obligation off, and we pay cash. And again, the right way to do that entry would be to record the payment of the cash, remove the asset liability obligation. Debits don't equal credits, and so our plug is the $6,840 loss.